Yo, do you know all of the different types of loans available to you when you are buying a home? Or what the difference is between a conventional loan or an unconventional loan? Knowing these terms and your options makes all the difference between getting a better deal on your home loan and saving thousands of dollars versus paying a premium for a home loan. So stick around as I go over more top terms that you must know before buying a home in 2022. Coming right up. What's up guys, I'm Vince, Hawaii Realtor, here to put the real in real estate. In last week's episode, I went over the top terms you must know when you are searching for your future home, writing offers, and a little bit of going into escrow. Today, I'll go over the top terms and concepts you must know when you are applying or qualifying for a home loan, a mortgage. Now, before I begin, if you haven't watched the part 1 of this video, then please go ahead and watch that first because it kind of does tie into this video. That being said, let's go ahead and start with the basics. When you're buying a home, you most likely have to borrow money from the bank. Now, the bank wants to make sure that they do get a return on their money that you borrowed. Let's call this borrowed amount the principal. So what does the lenders, the bank, do? They ask you for a down payment. This is a percentage of the principal or the amount that you're borrowing that you end up having to pay up front. This is partly to ensure that they get some of their money already and also to make sure that you are a serious buyer. The more of a down payment that you put down essentially is better because that's less money that you are borrowing. And the less that you borrow means the less interest that you have to pay on top of the money you're borrowing. Interest is the fee that the bank charges for you borrowing money from them. And that's because banks, on the grand scheme of things, are somewhat of a business. They aren't just giving out free money. They do want a return on their investment. And again, the return on their investment is that extra interest that they're charging you. So the amount of interest that you're charged is determined by the interest rate. This is expressed usually in a percentage. And then this interest rate is determined by the home loan that you qualify for. The better your qualifications, the lower your interest rates are, and the better terms you get between you and the bank. And what does good qualifications look like? Well, I do have this video here that I created a few weeks back. It shows you the lending standards and qualifications to buy a home or to qualify for a home loan in 2021. Okay, so what kind of home loans are there? Well, every home loan that is available is categorized into two different, a conventional loan and an unconventional loan. The easiest way to tell them apart is that conventional is, as you can imagine, guys in suits and a tie, versus an unconventional loan is Uncle Sam, the government. This means that conventional loans are not backed by the government or insured by the government. It is backed by the bank itself. Essentially, it is a loan from a private lender, a business. Whereas unconventional loans are backed by the government or insured by the government. These types of loans were created to benefit a specific group or a community that could not afford a home without some type of assistance. People like first-time home buyers or those that served in the US Armed Forces, the military. Okay, so let's start with the unconventional loans. You have the FHA, the VA, and the USDA. FHA is insured by HUD, which is the Department of Housing and Urban Development. It is a government department. This is a loan typically for first-time home buyers or those with low to medium incomes, people that want or need to buy a home right now, but they just can't afford to save up that down payment or they don't have the best credits. The great thing about the FHA loan is that it only requires you to have 3.5% down versus the usual 5% down for a conventional loan. Also, the minimum credit requirement for this kind of loan would be at the minimum 580 versus a regular conventional loan at this current moment is most likely around 660, 680. Now, of course, there is always a catch to something that seems too good to be true, and it's in the form of higher interest rates and overall a higher mortgage payment every month. And this is because of something we call MIP, Mortgage Insurance Premium. It is an additional charge on top of your mortgage that they use to insure the bank because typically this group of people, first-time home buyers or low to moderate income people, are more riskier to loan money to. So they charge you that initial fee to, just in case, recuperate some kind of funds now in case you end up not paying the full amount later on. Now, normally this kind of payment is nothing to sweat. It kind of just makes sense. But for the FHA, worst of all, this thing called MIP, it does not tack off. What I mean by that is on a regular conventional loan, they have something very similar to this called the PMI, which is the private mortgage insurance. If you're borrowing the loan and you're putting down less than 20%, you will have that PMI on top of your mortgage. But after that 20% is paid off, then it actually falls off of the mortgage payment. You don't have to pay it anymore. But with the MIP on an FHA loan, it never comes off. So you have to pay that for the rest of the loan. So many of you after hearing that would be like, oh man, I don't think I would want that, to have to pay that for the rest of the loan. Why would anyone want this loan? Well, it's not a completely useless loan as it sounds. It is for those that absolutely need a home right now, and they just don't have the time to build up their credit, or they're just not in a situation to be able to save more to save for that down payment. And the mortgage payment with the MIP, additionally, it doesn't really change it all that much, like to a significant amount where it doesn't make any sense to pay this. Given in the situation, it may make sense that you could probably still pay that monthly mortgage, you just can't pay that much down payment. So maybe this loan would be good for you. Again, it is dependent on your circumstances. Okay, so moving on from that, we do have next the VA. Now, I am actually a VA specialist, and I wanted to save this topic for another video because I believe it's probably the greatest loan you could have, but that's only if, of course, you can qualify for it. So now FHA was insured by the government. The VA is guaranteed. So what that means is that the VA is zero down payment and no PMI. And on top of that, there is a limit to how much you can be charged for the closing costs. There is a whole list of other benefits, but anyways, the point being is that this is a great loan if you can qualify for it, and the only ones that can qualify for it are those that are active military members or anyone that retired from the military as well. And then lastly, for the unconventional loans, we have the USDA. This loan is purely for rural areas, and to some it may seem like a good deal because it does offer that zero down payment just like the VA, except like I mentioned, it is only for rural areas, and in many places, even here on the island, that doesn't give you a lot of options for homes. Not only that, but you can't refinance later, and there is a prepayment penalty, so you're not allowed to pay down your mortgage sooner. So overall, that ends up not being a very good option for a lot of people, but who knows, some of you may prefer to live in rural areas, and if you can qualify for it, sure, why not? So that's the main ones for the unconventional loans that are backed by the government. Now let's move on to conventional loans. Conventional loans fall into two subcategories, which we call the conforming loans versus the non-conforming loans. Let's start with conforming loans. Conforming loans are subject to the rules and guidelines of Fannie Mae and Freddie Mac. Basically, the regulators to make sure that banks don't approve loans that are ultimately risky, as well as to make sure that banks do not take advantage of borrowers like yourself. Normally, these conforming conventional loans will have better interest rates and better terms, and it gives you the option to put less down for the down payment on the loan. So as the name implies, conforming loans conform to the rules and guidelines of Fannie Mae, Freddie Mac. And so as you can guess, non-conforming loans are not subject to the guidelines or rules of Fannie Mae and Freddie Mac. And the reason for this is because typically these loans, these non-conforming loans, are used for bigger purchase price homes, so much more expensive homes. Essentially meaning the more money that the borrower is borrowing, the bank is going to want to see more out of you, some more qualifications. But traditionally, most people end up using a conforming conventional loan. And that's because it typically is the best one and offers the most amount of benefits. With a conforming conventional loan, it can come in many different forms, and you have many different options as to how you want to structure it. This is typically where you hear something like a 30-year fixed rate loan. You and the lender decide how you want to structure your loan in terms of how long your term is to pay it off, whether you want your rate fixed or adjustable. If rates being offered right now, for example, are very low, which they are, where right now we're seeing as low as 3 to 3.5%, then most likely you're going to want a fixed rate type of loan because you want to lock in that low rate for the life of the loan, essentially meaning you pay less interest, right? But let's say, for example, you bought your home, or you're buying your home in the next 5 years, or you had bought your home 5 years ago when the rate was or will be much more higher. Then in that case, you may want to sign up for an adjustable, which gives you the option to have a lower interest rate for the first 5 years or for a given period of time, and then it adjusts later on. However, this is only something you would want to use if, for example, you do not think you're going to be in the home for that much longer, or you happen to know that the interest rates will come down. This adjustable rate loan is what we call an ARM loan. adjustable rate mortgage. Now, ARM loans do have a bad reputation because it did have some part to play, and it was a major factor in the 07-08 real estate market crash. People chose to take out those ARM loans because it offered a really low interest rate at first, but after those 5 years, unfortunately, the interest rate kicked up significantly high, so high that a lot of homeowners couldn't afford to pay that extra amount of interest and thus losing their home. But does that mean the loan is bad altogether? Not exactly. At the time, absolutely it was, but it was because of the lack of understanding between the lender and the borrower, as well as a lack of stricter lending practices and requirements. A lot of these people taking out these ARM loans should not have taken out those types of loans, and lenders should not have let them take them out. Anyways, so what does this mean for you? Why is this important to know? Well, when you go and visit a lender to take out a home loan, typically they will recommend you the loan that fits the most for you, that you qualify for. But after watching this video, now you do have the option to ask your lender, this is something you pay them for, to see every option available to you. If you want to break it down between a 30-year loan to a 15, or if you want to see if you qualify for the VA versus the conventional. Even if you qualify for the VA, we know that's amazing. Is there a reason why you should get a conventional instead? You want to weigh out your options now that you know the different types. Understand that the main things that you want to pay attention to would be the interest rate that you qualify for, the down payment that they require of you, or the length of the term, as in how long it is that you're going to need to pay this loan, whether or not you have mortgage insurance like PMI or MIP, what your closing costs are and what they entail, and then lastly, whether or not you have prepayment penalties if you were to pay this earlier. Understand that if you have a better deal in one of these things or a couple of these things, it's subtracting or taking away from something else. A lower interest rate could mean more down payment or additional fees in your closing costs. All of this information here should be provided to you early on, or at least an estimate of it, so that way you know what you're signing up for, and that way you can make changes that suit you better and that you value more. What I mean by this is, if for example, you do not want to tie down that much money in a down payment because you want more cash to either invest or just to play around with or save more, then you're going to need to understand or be okay with the fact that your interest rate won't be as low as you can qualify for. Let's say if you can qualify for a 3.25, they may bump it up to a 3.5 to compensate for the fact that you're only putting down the minimum down payments. But on the flip side, maybe you truly value having the least amount of interest so you have less interest to pay for the life of the loan. Then in that case, you need to prioritize putting more money down, or maybe even paying an additional fees to the lender to keep your interest rate low. Now, there are many different things that you can do to guarantee a lower interest rate or to pay less money and save money through the escrow process, but that I'm gonna have to save for another video. I know, that's right, I only thought I was gonna do a part 2 for these top terms, but there are more terms that I did not account for that I do think you absolutely should know, so I'm breaking it up. I'm gonna do a part 3. But anyways, that is the biggest thing that you will need to know concept-wise and the terms when you're qualifying for a home loan and when you're buying a home in 2022. In part 3, I'll go over and I'll finish and continue where I left off in part 1 with escrow and all the things you're gonna need to know there. Like for example, the closing cost and what that entails, all broken down. For now, thanks for being here. I really appreciate you. If you haven't, I would love for you to subscribe to my channel and to like this video. That way you can stick around and continue to watch our growth together, and I can provide you more good tips and trade secrets that no one else is going to tell you. Other than that, also, if you would like to leave a comment, if you have any questions or if you just want to chat, please do so. Anyways, have a great week, and I'll see you when I see you. Peace.